The broadcast is now starting. All attendees are in listen-only mode.
Hello, everybody. We're going to be starting in just a minute or two. Give everyone a chance to log on. All right, thank you, everybody, for joining us today for one of our webinars. This webinar is just one in our continuing education series. Please check out our website for past webinars on various topics. My name is Carol Karansky. I'm a principal here at Wilkin & Guttenplan, and I've been with the firm for 25 years, this month as a matter of fact. And today's topics are interfund balances and deferred maintenance fund. We get so many questions on these two topics, I'm sure that you're going to find this session very informative. Joining me today are our speakers, Mohammed Saliani. Mohammed is also a principal with the firm, and he's been with us for 17 years. Mohammed specializes in providing audit, review, and compilation services to condominium and homeowner associations, nonprofit associations, closely held businesses, and other real estate entities. Additionally, he provides consulting and agreed upon procedures for many condominium and homeowner associations. Mohammed's currently on the executive board of CAI. I'm sure many of you have heard Mohammed speak or have dealt with Mohammed in the past. Our other speaker today is Mike Mezzo. Mike's a supervisor with our firm, and he's been with us for about 5 years. He also specializes in providing audit and accounting services for condominium and homeowner associations, as well as closely held businesses and telecommunication and software companies. Before we get started, we have a few little housekeeping rules to go through. First, to ask any questions during the webinar, please use the questions pane in the GoToWebinar dashboard on your screen. We will try to answer as many questions as possible. We'll be polling our audience throughout the presentation. This will help us get a sense of the participants and their experience. And lastly, the webinar is being recorded and will be uploaded to our website, www.wgcpas.com. So feel free to type in the questions as you go along. We may not answer them as you're going, as we see them. We may wait for the presenter to finish talking about a topic, but we will be accumulating all of them, and we will be asking them hopefully at some point depending on time. So just to get started, we always like to know who's in our audience, who's listening, so that helps us in some of our answering the questions and also adding a little bit extra discussion. So who's in our audience today? Board members, managers, committee members, such as audit, finance, or others. So if you could just answer. Okay. So pretty much everybody has, most people have answered, not everybody, but most, but it looks like primarily it's board members as well as a large amount of property managers. So thank you all for joining, and hopefully we'll be able to direct a lot of the questions and a lot of discussion towards what you're interested in. Okay, so let's get started. Mike's going to start us off on interfund balances, and I'm going to turn it over to you now, Mike.
Perfect. Thanks so much, Carol. So I'm sure I've interacted or worked with some people that are calling in, but just for those who haven't, as Carol mentioned, my name is Mike Mezzo. I'm a supervisor here. I've been here for about 5 years and did 3 years with another CPA before, so I have a decent amount of experience. I've been working with the condos pretty much since I started up here at Wilkin & Guttenplan. So I'll be going through interfund balances today. And I just wanted to reiterate also, if you do have any questions that come up, feel free to type them in, and we'll try to get to them throughout the presentation as we work through. So feel free to type in any questions that come up, and we'll try to get to them as we work through the presentation. Okay, so to start out, I'm just going to go through an overview of what we'll actually cover today. So first off, we're going to talk about what is an interfund. We'll cover what makes it up and what are some common causes of interfund balances. So, certain transactions or scenarios that typically result in an interfund balance. We'll cover some of those. Then we'll get into some implications of having an interfund balance. So in this section, we'll kind of talk about, now you're aware that you do have an interfund balance, why should I be concerned? What flags should be raised? And, why is this something that we're even talking about today? And then lastly, we'll kind of go through what to do if you find yourself with a significant interfund balance. So we'll kind of walk through some of the steps that you should be taking in order to work through eliminating those interfund balances. So in order to, before we can kind of go through and explain what an interfund balance is, it's very important to first understand the underlying accounting method of fund accounting. So associations typically utilize a method of accounting known as fund accounting. So I'm sure that most people listening in are familiar with those funds, and I included a table here on this slide as well that kind of breaks out some of the more common funds that we see. Just to note, you might be involved in an association or site, that has 8 or 10 or north of that amount of funds. An association can really have as many funds as they seem fit for their purpose and operations. Some have transition funds, activities funds, snow funds. There's really a wide array of funds that you could have, and it's important to note that even though we're only talking about these 3 funds today, the concepts and principles that we'll be talking about of interfund balances really apply to all those funds the same. As we go through. So I'll kind of just briefly touch and give a recap on the 3 most common funds that are in this table below. I'll start actually from the bottom up. The first is a replacement fund. I'm sure most people are familiar with this as well. This is typically going to be the fund that you utilize to put away money and track activity related to your common elements and capital components. So generally, this is everything that's included in that engineering study. So when the engineer comes in and prepares that reserve study, you can actually go in and there's a component schedule which will break out all of the individual components on the site. And it'll include their replacement costs, their average remaining useful life, and all that information. So this fund is really meant to track the funding for those items for when they need to be replaced, as well as when they do need to be replaced, any of those expenditures incurred in replacing them. The deferred maintenance fund, these are things that you do need to save for. We say they occur less frequently than annually. So these are every 3 to 5 years. The most common ones are painting, staining, caulking. And they're things that you still need to save for, but they're not going to pop up in your budget every year. So, typically, say a power washing project is going to, cost you $3,000. Rather than put that all in one shot and your budget in 1 year, the deferred maintenance fund kind of allows you to make a schedule for that and maybe put, $1,000 aside for 3 years. This way, it's kind of an easier pill to swallow on your budget. And then the last fund on the top there is the operating fund. This is really meant to capture all of your remaining daily operating expenses. So all the expenses that are needed just to run the site and keep the site moving. So this is your landscaping, your snow removal, also legal fees, engineering, management fees, all those, expenses that are needed for the day-to-day operation of the site. That's all going to be left to be funded through the operating fund. So, based on how many funds your site has, specifically, the real purpose behind fund accounting is that for each purpose of the fund, you want to keep all that activity, the financial activity, recorded separately. You want to keep it segregated from the other funds. This way, it's easy to track all of your replacement fund activity at a given year and deferred maintenance fund, and likewise for operating. So it's a good way to kind of segregate and track the activity. This way, it doesn't get mixed in amongst the other funds. So now that we kind of discussed fund accounting itself, we can kind of go into what an interfund balance is itself. So really, in its simplest form, an interfund balance occurs when you use one fund to record another fund's activity. So it's almost like an IOU. It results in a fund owing money to another fund. So to kind of illustrate this, I just jotted down 2 quick examples that we could talk through. For example, a special assessment. If you had a special assessment, say for a large capital project, you would, if you needed to assess for it, you would bill that assessment and you would record it as income to the replacement fund. However, once that's assessed to the unit owners and those cash receipts from the unit owners start coming in, that's oftentimes gets recorded the cash in the operating fund. So the association would then have to transfer that cash from the operating fund over to the replacement fund. just to point out, if that last step isn't completed, it would result in an interfund. So if unit owner receipts come in and they're deposited into the operating fund and the association never actually transfers that over to the replacement fund, you'll find yourself in a situation where the income got recorded in the replacement fund, but the cash got recorded in the operating fund. So that's a good example of how you can see that one transaction can sometimes get actually recorded into two different funds, and that would result in an interfund. Just to kind of give another quick example, and following up on the example I just gave, if you do have that capital project that you assessed for, once the time comes to actually pay the vendor invoices for that project, say it was a roofing project, and as you work through, the vendor is going to invoice that. Sometimes that might get paid out of the operating fund. So, the replacement fund oftentimes has higher cash balances just due to the fact that you're putting money away for those bigger ticket items. So your replacement fund cash is usually one of the higher cash balances that you have. And associations will often, try to take advantage of those higher cash balances by investing those funds. So sometimes it's not as easy to cut checks and make cash disbursements out of those investment funds, and it's just easier for the association to cut them out of the operating fund. So that's another example of when we see that expenses might get recorded to the replacement fund, but then they actually wound up getting paid out of the operating fund just because it's easier to disperse those checks. So those are just kind of two quick examples to show you how one transaction might actually cross over multiple funds and get recorded in multiple different funds. So one of the big questions that we get is, we kind of talked about what an interfund balance is, but a lot of questions that usually popular are, how do I know if if I have interfund balances or if my association is being affected by interfund balances? So I just wanted to include a quick little shot here of where you can look. So this is an excerpt that I took from a balance sheet in an audited financial statement. And what I did is I actually highlighted right there on the bottom in blue that interfund balance line item. So when you're reviewing your audited financial statements on an annual basis, this is a great spot to look and would clearly identify if you do have interfund balances affecting your association. And just to note, this is a good point to reference as well, back to what I was discussing earlier. Under fund accounting, all of the activity for each fund should be recorded separately. And as you can see here in the financial statements, each fund has its own column. So the replacement fund is going to have its own mini balance sheet there, just like the deferred maintenance fund and operating fund. And all the activity related to those funds should be within that respective column. So the interfund balances there would indicate that some activity from one fund got recorded into another fund.
Mike, we can see this here, like on the audited financial statements. What about if somebody wants to look during the year at their internal financial statements?
Yeah, that's a great question as well. And you can also look in the monthly financial package. Sometimes they wouldn't be listed as maybe an interfund balance, but more commonly what I see is that they'll be listed as due to replacement fund or due from deferred maintenance fund. So that's a good point that Carol made, that when you're looking through the monthly financials prepared by management, you want to look for those due to accounts and see, that would be a good place to indicate that you have some interfunds present if you see those. So to kind of help walk us through and gain an understanding of the concepts, I put in a quick example. And I know that I think I was a few days late. We're having this heat wave now with this 40-degree weather. So I don't know if this snow is still applicable, but it was applicable at the time. So I'm going to go through some facts, and we'll kind of walk through the facts together. And then I'll have a slide with some possible answers. So I'll kind of go through the facts. Like I said, we'll read through the possible answers, and then everyone will actually have a chance to answer the question through the polling. And then we can go through and review the correct answer. So some of the facts, the association had a snowstorm in January. They received a snow invoice from the vendor for $60,000, which is due on February 1st. During that month, the operating fund cash balance had $20,000 available as of January 31st, and the replacement fund cash balance had about $100,000 as of January 31st. So as you can see, the association did not have sufficient operating fund cash to pay the invoice. So under the next set of facts, what they did is that they paid the $20,000 out of the operating fund, and then they also borrowed $40,000 of replacement fund cash in order to cover the rest of the invoice. So on the bottom, I kind of summarized here. You can see cash used from operating fund was $20,000. Cash used from the replacement fund was $40,000 for the total amount dispersed of $60,000. So I'll give everyone just a minute if you wanted to jot down any facts or numbers from there. Okay, and we'll move on to the possible answers on the next slide now. So based on that information, what impact will this transaction have on the association's financial statements? So point A is that the transaction will result in an interfund of $40,000 between the operating and replacement fund. Point B is that the transaction will result in an interfund of $20,000 between the operating and replacement fund. Point C is that the transaction will result in an interfund of $60,000 between the operating and replacement fund. And point D is that there will be no impact from this transaction on the interfund balances. So we'll give everyone just a few minutes there to review those options and make their selections.
Okay, it looks like a lot of people are getting their answers in. We'll just give it another second or so. You challenged them with the question, Mike.
I know.
This is a little more difficult than deciding what kind of listener you are. So, all right. So a good number of you have voted and given your answers. Okay, and let's just get the results to say. Oh, okay. I'm sorry, I didn't see. Most of you said that there'll be an interfund of $40,000 between the operating and replacement funds.
That's great. So I guess everyone was paying attention. That's very good news. That is the correct answer, point A. That transaction will result in an interfund of $40,000 between the operating and replacement fund. And just to kind of illustrate that as well, I'm a visual learner myself. I don't know if there's any out there, so I put this table into the slide as well, just to kind of visualize what happened there. So if you look in that table, the cash row, you could see that, both the cash and expense row sum up to, going across $60,000, which was the total amount of the transaction. However, the cash was split. $20,000 hit the operating fund, and the remaining $40,000 hit the replacement fund. So that portion of the transaction hit two funds. On the expense side, the full fund hit the operating fund. So by drawing it out like this, we can clearly see that $40,000 of that invoice was covered by the replacement fund and will now be back due to the replacement fund from the operating fund. So as you can see on the bottom there, the operating fund owes the replacement fund $40,000. Okay. So we kind of went through at this point, the method of fund accounting. We talked about what an interfund is and some examples of transactions that may result in them. And now we'll kind of touch on some common causes that, if you find yourself in these situations, it could be a common cause that you might have an interfund balance as a result of the situation. So the first one and most common one that we see is just a timing difference of cash flows. Regardless of what type of a financial position your association is in, even if you're operating at a surplus and you have a very accurate budget that's updated annually, it's kind of inevitable that as a business, you're going to have times during the year where you're going to have some dips in your cash flow. So whether it be due to, maybe some unit owner payments came in late, whatever it may be. It's not uncommon for an association or any business to have periods of time during the year where they find themselves light on cash and have a hard time covering their bills. So in situations like that, it's not uncommon for the association to borrow funds from another fund to cover an invoice. So just to give an example, if you have like that snow invoice we talked about on the previous example, if you had that snow invoice due on February 1st and you didn't have enough operating fund cash to cover that invoice, what if you had that situation and you had $200,000 sitting in your deferred maintenance account and you really didn't have any intended use for those funds over the next 2 years? You know, a board might sit there and ask themselves, why would I incur a late fee by paying this late, or any, you know, maybe there's interest charged on the balance that's past due. Why would I incur any of those expenses if I have this $200,000 sitting here into my deferred maintenance not being used? So that's one of the common causes that we see when boards tend to utilize funds from another fund to cover some dips in the cash flow.
Mike, before you go on to the next timing difference, the next common cause, do you want to just go back 2 slides? Can we go back or no? Okay, right this here on this one, yeah. There just a question came in and saying, okay, so now on our financial statements, we do have an interfund. You can see the interfund of 40, which you discussed. Will it show? How will it show? Will it be positive or negative, like on the balance sheet?
Yeah.
So where will they see that, and will it be a positive or negative number?
So the way I like to think about it is that if it's included in that asset section, like we talked about before. So we can kind of go back a few slides. I don't think it's too far away. So here's a great example. So the way I like to think about it is that if it's listed as a positive number in the asset section, it's almost like a receivable balance. So in this situation that I'm looking at, I would see it as the replacement fund is owed $75,000, and the deferred maintenance fund is owed $25,000, and the operating fund is the one that owes that money to both of them. So when they're included in the asset section like this, a good way to think about it is just that a positive number is like a receivable, and a negative number it would be as like a payable, so almost like a liability. So sometimes, depending on how your financial statements are presented, you might see that there might be broken out into 2 sections. You might have under your assets the interfunds of 25 and 75 in your asset section, rather than show the negative 100 in the asset section. Sometimes they'll put a line in the liability section below, right under assessments received in advance, if everyone sees that line item. You might also see a line item down there that might say due to other funds of $100,000. So that would be shown as a positive down there. But when they're grouped together in the assets, I usually like to view it as a positive is a receivable and the negative is a payable.
Okay, great. Okay. So that the 40 would be the positive in the replacement, and the 40 would be the negative in operating.
Correct.
So hopefully that clears up that question. Thanks, Mike, for going back.
So now I just have to click through. Yep.
All right. We got to see your
almost
little snowman again.
I know. Yeah. Okay. It was hard to find.
All right.
So going back to those timing differences, I put a point in on working capital. Just because, you know, I know a lot of associations already utilize working capital, but if you don't, it's something to consider, because it can help in situations such as this where you have ebbs and flows in your cash flow throughout the year. So when you find yourself on those times when you don't necessarily have sufficient cash to pay your operating needs, you'll have that working capital fund kind of as a cushion or pillow to fall back on for those given months. So the next common cause I just wanted to talk about is deficits. So a lot of times, you know, a deficit can either relate to, you know, one isolated instance. Sometimes I'll see that association only has a deficit in a given year. Maybe they have transition going on or something, and it relates to one isolated, you know, circumstance. Or I've also seen deficits where they are, you know, just maybe representative of budgets that haven't been updated, for example. So you've been operating at a budget for 5 or 6 years, at a deficit rather, for 5 or 6 years, and now you have a large accumulated deficit. So when we see these deficits, chances are if you're operating at a loss, you're not going to have that sufficient cash to cover your operating needs. So when boards find themselves in that situation, you know, they're kind of faced with the need of, we need to pay our operating expenses. We kind of have to look through what our immediate cash requirements are and see what we can put off. So one of the biggest things that often gets put off is that replacement fund contribution. It puts a lot of strain on the other funds, and you know, if an association needs to pay their landscaping and snow and they don't have any money left over to actually transfer that cash over for their replacement fund contribution, that's another situation where it's going to result in an interfund balance. So we have a few more common causes on the next slide as well. Restricted investments, this is just one I know, as I mentioned earlier, that the reserves typically have higher cash balances and sometimes get invested in different types of investments that have maturities. So the two that I see most common are certificates of deposit and bonds. So just to note, you just want to make sure you're going through your upcoming projects. If you know that your roofs might be coming due in 3 years or so, make sure, review your investments, make sure that you're not investing in a 5 or 10-year CD then. You want those funds to be liquid and available for when those projects arise. And lastly, the last common cause we see is it happens. It's just human error. Sometimes a check might be coded to the wrong bank account, or maybe the accountant records the transaction to the wrong expense account in the general ledger. These things happen during the year, but if they do happen on certain transactions that cross multiple funds, you could find yourself with the result of an interfund. So some of the implications, like I mentioned before, that we would talk about these are things that, when I'm looking through a financial, or, when we're doing our annual audit, if we see these large interfunds, these are kind of the things that, might concern us, or some of the red flags that we might raise when we see them. So with respect to a large amount due to the replacement fund, if I see that there is a large interfund that's due to the replacement fund, right off the bat, I might think that there's, maybe some deficit issues in the operating fund. Maybe the operating fund is running at a deficit. So what would really happen, like I discussed before, is that maybe that cash is more immediately needed in the operating fund. So the association is maybe not making those contributions every month and transferring that cash over to the replacement fund, because that cash needs to stay in the operating fund. On the flip side, that's kind of the current and future funding. The association might find itself in a more serious deficit, where not only are they not currently funding, they might also dip into the amounts that were previously funded to the replacement fund. So not only are you not funding the current fund, funding for the replacement fund, you might also be dipping into last year's funding or the year before. So when we do see those large amounts due to the replacement fund, the first thing that I would look at is, is there an operating fund deficit? Has the budget been updated? Is it a recurring problem? Have they been operating at an operating fund deficit for 4 or 5 years consistently? And then I would really look to the budget to see if that's something that is updated annually. So just another implication that I'll touch on briefly, tax issues as well. So those replacement fund contributions, like I mentioned before, are really intended for capital improvements, and as such, they're viewed as capital contributions in the eyes of the IRS. So when those large amounts are due to the replacement fund, it would indicate that those replacement fund cash contributions have actually been used for operating needs rather than for capital improvements. So that's just another red flag that comes across when we see it, and is something to consider as well. So what do you do now if you find yourself, you get your audited annual financial statements, or you're looking through your monthly financial statements, what do you do? What are the steps that you take if you find yourself in a situation where you have significant interfund balances? And the biggest thing is just to identify the underlying cause. So this isn't always the easiest process in the world, but in order to know how to fix it, we really need to know what caused the interfund. So that's really the biggest step in starting the process of eliminating those interfunds, is determining what caused the interfunds. So interfunds can sometimes be caused by isolated transactions. I think I gave the example before, you might record the income from a special assessment in one fund, but maybe the cash came in and was deposited into another fund. Same for capital projects. You might have a project that's being expensed to one fund, but actually the cash is being paid from another bank account. And like I said before, it might just be a simple transaction that was a human error. Maybe, the accountant just mistakenly hit the wrong general ledger account when recording a transaction, and it resulted in an interfund. So these are usually easier to identify, and they're, easier to fix, because you have a solid background on what caused the interfund, and you can, kind of game plan on what the best solution is to eliminate it. The harder ones to identify are when they span across multiple different transactions. So Just waiting for that graph. I want to make sure I was all. So sometimes an interfund it might not be overly significant, and maybe it got overlooked, by the board when they were reviewing their financial statements, and maybe they never addressed the fact that they had a 20,000 interfund balance in a given year. But the thing is, if that doesn't get addressed, what happens if in the next year you have another 25,000, and then the next year another 25? Even though none of them were overly significant, it really can accumulate over time, and then you might find yourself with an interfund balance of over $100,000 or so. That's quite significant. That really needs to be addressed. And the problem is when you don't address them on a live activity, up to date every month, annually, when you're not reviewing them and addressing them on that basis, it's really hard to determine what the cause was, and it's harder then to obviously come up with a solution to eliminate them. So the important takeaways for today with respect to those interfunds are to really monitor the financial activity as often as possible. You really want to be looking at those monthly financial packages, and even at best, if you're not looking at the monthly ones, make sure that you're looking at your annual audit and identifying on your balance sheet if you do have those interfunds. So if you see that those interfunds are present, the next step is to then determine the source. Like we said, if it's one transaction, it's usually a lot easier to identify, and is much easier to identify when you're only looking at 1 year's worth of activity. If you have accumulated interfunds that have accumulated over 5 years, you're then tasked with the job of looking through 5 years of activity to try to determine where that sourced, and it could be very difficult. And once you go through those steps and you have an idea of what caused the interfund, we always recommend working with your management team to identify the best solution to eliminate the interfund. So unfortunately, with respect to interfunds, there's no one-size-fits-all solution. Every interfund is very specific to either a specific transaction, or certain sites might have different issues, deficit issues going on between the various funds. So there's really no one-size-fits-all answer. The real thing is to identify what caused the interfund, and then like we mentioned, you can work together with your audit team, with your management team, to come up with the solution to best fits your site to eliminate that interfund.
So before we go on to Mohammed, thanks a lot, Mike. A couple questions we just want to go through, some questions that came in. So take a breath of air,
Yep.
and then we'll ask you a couple questions before we move on. So the first question is, if you have an interfund, what's a reasonable period of time to pay back an interfund balance?
So we always recommend that you want to do it as soon as possible. We do recognize, though, that associations, if you have a very large interfund, they might not have the cash on hand to pay that back immediately. So we always recommend doing it as soon as possible. If it is something that's going to span over a few months or maybe even a few years, you just want to make sure that you document that. You want to have a plan in place to address it, and you want to document it this way. Maybe if you're not on the board, in a few years when the repayment's still going on, the next board members can easily come on and see what the plan was and have a documentation and a plan to follow for repayment of that.
Okay. Sometimes when the interfund is due to deficits and it has to go over a period of time, then even putting like a line item in the budget for repayment of interfunds is a way that boards can track it. What about if the interfund is so large and you can't repay it?
Mm-hmm. So in situations like that, I think that the interfund would most likely be tied to a deficit issue. So I have seen associations and worked on associations where they do have these extremely large accumulated interfund balances, and they simply just don't have the cash to repay it. So in those instances, it's kind of, you should always do things early and often, I say. So when you see that you have a deficit, you should address it early and often. When you see an interfund, you should address it early and often. Because unfortunately, in a situation like this, I would think that one of the only ways to come up with that money is to assess the unit owners. That those funds do have to get repaid to the respective fund. And if your regular budget isn't providing you with sufficient cash to repay that, you would either need to put a recurring line item in the budget or pass a special assessment in a year to collect those funds.
Can you just elaborate just a little bit on the IRS implications of the use of reserve funds for operating expenses?
Yeah, it's Mohammed here. So, well, the thing is that the IRS requirements, one of the requirements is that you keep the funds, the cash, in a separate bank account. And so if the association has an interfund balance and is basically utilizing the cash in the replacement fund for paying operating expenses, so there's intermingling going on there within the association's cash, and therefore it's not being segregated, and you're not in accordance with IRS requirements. And so if the association ever did get audited, the IRS could come and say that you're not segregating your funds, therefore this is really a operating surplus. It's not monies being kept aside for replacement fund needs.
And if it's an operating surplus, you could have a tax situation.
Absolutely.
And it could all be taxed. So sometimes we put these management letter comments in, and if the replacement fund balance is significant, it could be a potential significant tax. So that's really the concern. You certainly want to avoid any issue with that.
Yeah, Mike, when you were talking earlier about the interfund, the large interfund balances, sometimes you have to look at the reality of the situation and see, is this interfund balance so large that it's never really going to be repaid, and you have this huge deficit in the operating fund? Sometimes it's may just be better to clean the slate and say, okay, let's start over. Let's look at how much cash is in the replacement fund, do an interfund transfer to bring the fund in the replacement fund in accordance with the cash, and that might eliminate a major portion of the deficit, and say, let's start from here and move forward, have the study updated, and have a clean slate.
So that, Mohammed, you mentioned that, and a question just came in while you were talking about that. And, can the interfund be cured by doing a journal entry and doing interfund transfer, and which is just what you discussed. So the thing to follow along with that is then what type of tax return is filed. And yes, the question actually came in, oh, what about an 1120H? And yes, that's the answer.
Yep.
So you wouldn't file a regular 1120, we'd have to file an 1120H. We can't go into the difference in filings today. Unfortunately, we just don't have enough time. But 1120H, different items are tax subject to taxable income. So, there could be other implications, but certainly that's something to discuss with your W&G auditor, and understand what all the implications are.
All right.
I think we'll go on. We have a number of other questions that came in on Mike's topic, but let's do Mohammed. We'll cover deferred maintenance, and then we will come back to the other questions afterwards.
I know Mike did the major one. That's what everybody came in to listen for. But we'll talk a little bit about deferred maintenance here right now. Mike actually stole a little bit of my thunder right in the beginning, but I'm going to forgive him for it anyway. It's okay. So deferred maintenance.
I think we do have a polling question.
So the forgotten fund. So before we go into the polling question, I'm just going to say, when we mention here the forgotten fund, what we do mean here is that people sometimes forget what it's really for. So let's go into the polling question here. So the question is, do you live in or work with an association that has established a deferred maintenance fund and allocates funds annually? So let's see.
So again, just to kind of get a feel, are people familiar with the deferred maintenance fund and understand what it is? And that helps us in our discussion for sure. So interestingly enough, I would have thought it would have been almost 100% that they did, but that's not the case. Almost everybody has responded, and about 70% live in or work with an association that does have a deferred maintenance fund, and about 30% do not have a deferred maintenance fund.
Wow. Okay, that's pretty interesting.
Yeah, actually. That's different than what I would have thought.
Yeah. Mm-hmm. So the thing is that, as I said earlier, people tend to forget what the deferred maintenance fund is to be used for. A lot of people consider it to be a catch-all fund. I get questions all the time where people will ask me and say, hey, I have an expense that came up that I really did not anticipate, and so can I charge the deferred maintenance for it? And it's not a catch-all fund. It's a very specific fund for certain specific items that we will talk about. If you have a unforeseen, unbudgeted expense that came up, what you should really have, and what we recommend, is to have a line in your operating budget that says contingency. And that's where you charge the unforeseen, unbudgeted items, because you have this contingency. That's your catch-all line. The contingency is the catch-all line. That's where you should go for these expenses and not turn to the deferred maintenance fund. So we're going to talk about, so what is really being deferred? Okay, I'm going to give you a little bit of my personal opinion here. I'm really, I'm a very opinionated person, as some of you know, but I'm really not a fan of the name deferred maintenance fund, because it's really misleading. A lot of people ask me, so why are we deferring the maintenance work? You're not deferring maintenance work. That's not what the deferred maintenance fund is for. You're actually deferring money to do maintenance work that occurs less frequently than annually. If it was up to me, I'd do a poll and ask people, what should you call it? I haven't, give an example. So call it a non-annual maintenance fund or something like that. Don't call it a deferred maintenance fund.
That's too, well, that's too many words.
Maybe it is, but we can come up with something else. But I just think deferred maintenance is a little bit of a misleading name here. So that's what you're doing. You're putting money aside for maintenance work that occurs less frequently than annually. So, okay. So what makes up the allocations to the deferred maintenance fund? It's really for anything that the board wants to fund for that occurs less frequently than annually, as I said. So, for example, you have painting. You will paint. Maybe you paint every 3 to 5 years, and you need to fund for it. So you put money aside in there so that you have enough money when the next painting project comes up. Staining of the decks. You don't do that every year. You do that every couple of years. Power washing of either the sidewalks or the siding of the association or buildings, or mulching. Now, these are some of the maintenance work that occur less frequently than annually, but there are some other expenses that an association incurs that also are going to come up, but do not happen every year. And I have a couple of examples. For example, if you live in a condo association, you're going to have the 5-year DCA inspections that will happen. And so every 5 years, the DCA comes in, and for those of you who don't know, DCA stands for the Department of Community Affairs, which is the organization that deals with condo associations while you're under transition. The developers work with them, and once you're done, condo associations get inspected every 5 years to make sure that they are up to code. Some of you may have experienced, they'll come in, and if you have condo buildings, they'll look at smoke detectors and exit signs and things like that. And if you're not up to code, then they give you a certain time period to bring yourself up to code. And they might even levy some fines and penalties on the building if that's the case. And some of us have seen that. So, but the DCA comes in every 5 years, and they're going to inspect you. And the cost of the inspection, even if there are no violations, there's still a cost of the inspection that the association has to bear. And it tends to be a few $1,000s. So if you fund for that, you include that in your deferred maintenance fund, and you put the money aside. So then you don't have this bump in the operating fund in the year that the inspection does occur. Another thing is the study, the reserve study. We recommend that you have the study updated every 3 to 5 years. So if you're going to update the study every 3 to 5 years, again, that's a few $1,000s that you're going to incur. Put that in your fund, in the schedule of the fund. And so when the study is updated, you have the money to be able to do it. You sometimes have to think outside the box and think of other expenses that you're going to incur, but they don't happen every year. So, okay. So why should the association fund for these items? One, it keeps the budget regulated. So as the example that I gave you earlier about the painting, say for example, the painting costs $50,000 and you're going to do it every 5 years. If you do not have the deferred maintenance and you don't budget for painting there, in year 5, suddenly you're going to have an operating expense of $50,000 that you're going to charge to your operating fund. You may not have budgeted for it, or if you decide to budget for it, then in that 1 year, everybody's maintenance fees goes up for that $50,000 and then goes down again, and it doesn't keep it regulated. So it's better to have it in the deferred maintenance fund, fund for that painting in there, collect $10,000 every year from everybody, year 5, you pay for the painting, and then you start all over again. And this way, it's kind of as a pay-as-you-use concept as well, because the people who are living there in year 1, they've paid their share. Maybe the one who's there in year 5 was only there for 6 months. Why should they incur the cost of painting for 5 years that while they were not there during that whole period of time? Then it also maintains the common elements and allows the association to use them for their fully expected useful lives. For example, you have roads, and if you do not seal coat them every 2 or 3 years as you're required to, you know that especially with the weather that we have, it's very easy to get cracks on the roads, and then you have to repave the roads much sooner than you would have had to if you had seal coated them on a regular basis. Another thing is, for example, the decks. If you do not stain the decks regularly, then of course the wood would rot because of the weather, the extreme weather conditions that we have, and you would have to replace those decks much sooner than what would have been expected when the decks were initially installed in the association. So it does maintain those elements. It lets you utilize them to the full extent of their expected useful lives, rather than you would have a much shorter useful life if you did not do the maintenance work on a regular basis. Also, it keeps up the value of the homes, because you know, it would be much harder to sell homes within an association where the roads are not maintained, the roads have cracks in them, they have potholes in them, the decks are not stained well, and the wood is rotting, or the siding is not power washed on a regular basis. You have the green stains on the siding, things like that. Of course, it devalues the homes. It's harder to sell the homes, and that's really what we're here for. We're here for to utilize, to live in the association, to maintain the value of the association. So as and when people want to sell their homes, they get a good resale value, and it keeps up the value of the homes. So how much do you need to fund? So basically, it's, you know, you can go out there and talk to your maintenance guy and say, okay, hey, you know what, I need to know how much money should I put aside to paint the clubhouse. But it's much more advisable to hire a professional to tell you how much should you fund for all these different maintenance items. And who's the professional that would know that? It's the engineer. The engineer knows the association. They've done the study for you. They've walked around the association. They have they know your common elements. They know what makes up the association, and they also have all these all the information available to them for the costing of these items. So, for example, they know in the clubhouse, they know the square feet within the clubhouse. They also know how much it costs to paint, you know, per square foot, and so they can calculate what amount of money you need to put aside to do the painting, and they can come up with the schedule that you need to be able to fund in accordance with to make sure that you have enough money in the deferred maintenance to be able to do the work that's necessary. So how often should you update the schedule? My suggestion is that every time you have the engineer come in and do the replacement fund schedule or the study, have them do the deferred maintenance study. First of all, they're right there. They're working with you on the replacement fund. It saves money. It'll make it much cheaper rather than have them come out separately and have the deferred maintenance schedule done separately. Every time you have the replacement fund study done, have the deferred maintenance schedule done. And also, while they're doing the walkthrough for the replacement fund, they'll also be able to tell you, like for example, on the road, how many more times can you just do crack filling and do seal coating on the roads before you'll actually have to repave the road. So it gives you an idea. They're the experts. They'll come in there and they'll be able to tell you what you need to do to be able to continue to utilize this asset or this common element before you need to have it replaced. Also, for example, if you have tennis courts, they'll tell you, okay, you can repaint the tennis courts and you'll be able to utilize them for the next 3 to 5 years before you have to resurface the tennis court. So the engineer is the best person, and it's always best to update the deferred maintenance schedule Every time they come in to do the replacement study, they can do your deferred maintenance schedule at that same time and fund in accordance with that schedule. Because if you don't fund in accordance with that schedule, then you're not going to have the money to be able to do the work that's listed in that schedule. And then once the engineer has given you a schedule and given you the engineering study, meet with them, go over the study, go over the schedule, discuss with them the schedule, and discuss with them your funding to make sure that you have enough money to do the work that's necessary. All right. So hopefully that gives you a brief idea of what the deferred maintenance fund is, what it's used for, how to fund for it, and how often do you need to update the schedule.
Okay, thanks, Mohammed. Certainly, even understanding that may help cut down a little on some interfunds if we know what each fund is actually being used for.
Absolutely, absolutely.
So we have some questions that came in. We've got about 10 minutes or so. So we'll read through the questions and we'll see how many of these questions we can get to. The first, Mohammed, it's relating to deferred maintenance. I think more on the interfunds, but we'll kind of go back and forth.
Okay, sure.
All right. So if I replace part of a roof on one of the buildings, can I use the deferred maintenance fund for that?
So it all depends on how much you're doing as far as your replacement is concerned. If you're doing a major portion of the roof, then actually I would suggest that you utilize the replacement fund for that, because that's what the money is there for, and you're actually extending the useful life of that roof. And that is also within the IRS guidelines. Now, but if you're replacing, say, a few shingles or things like that, I would rather charge the repairs and maintenance in the operating fund rather than charge the deferred maintenance fund, because repairs of the roof are really not supposed to be in that schedule of your deferred maintenance. So unless you have a situation where you don't have the money.
Right. Okay. All right. Okay. With respect to interfunds, is there a limit on how much money can be kept in the interfund account before it becomes a tax problem? So, go ahead.
Yeah, I was going to say no. I don't think it's a matter of. I don't think there's like a materiality concept with respect to that. It's just a treatment of how those funds are treated in the different funds. So I don't think there's a limit, but obviously, like we mentioned, you don't want to have an accumulated growth in an interfund. Even if it's a smaller interfund, you would want to take care of that on an annual basis rather than let it grow. But no, I don't think that there's a set dollar limit that is a threshold.
Right. You really want to keep your funds separate. That's really the whole, that's the guiding principle. So, you have $1 or $2, I wouldn't lose too much sleep over it, but it's a guiding principle to keep things separate. Another question on it, can you just wipe an interfund down to zero if you can't figure out how it came about? So
I think Mohammed actually touched on that before.
Yeah, if you're in that situation where you really can't figure out, it's a really large interfund balance, then you can do a resolution, do the interfund transfer, eliminate the interfund balances, and start with a clean slate.
Yeah.
And I think one of the important things Mohammed mentioned before too, and he talked about that, is you then do need to reevaluate, your actual cash balances and maybe have the engineering study updated to reflect that, because that'll have a big impact on your funding.
Absolutely. Yeah.
Okay. All right. So, Mohammed, you talked about a contingency line item and, to use that. But let's say we didn't do the contingency line item. We didn't know that. And so we have an expense we didn't budget for.
Right.
So what should we do? Charge it to the replacement fund or charge it to the deferred maintenance fund?
Well, it all depends. So in your deferred maintenance fund, first of all, if you have a deferred maintenance fund, you know what you're putting the money aside for. And if you do, and do you have enough money in there or even more than that to pay for those items that as and when they come up. So if you have more money in your deferred maintenance fund and you have an unforeseen expense, then yes, you can charge it to the deferred maintenance fund. But if you don't, then my suggestion is charge it to the operating fund, because there's no point in charging an expense to the deferred maintenance fund and creating a deficit balance or a negative balance in your deferred maintenance fund. If you charge it to the operating fund, have the deficit in the operating fund, and then work through the budget process in the next year to deal with it. Either you might have to increase your maintenance fees or do a one-time special assessment if it was a one-time unforeseen expense, or you're just not budgeting enough. So it's better to have the deficit in your operating fund rather than they have the deficit in your deferred maintenance fund.
Okay, let's see, I have a couple more minutes. Are there IRS restrictions on transferring money between operations and deferred, like there are between operating and reserve?
No, there are no IRS, because as far as the IRS is concerned, it's the replacement fund and everything else. Everything else goes into one bucket. So
Right. Okay. This is we did have a question. I'll just answer it really quickly. Anything in the new tax law that will affect associations, other than the corporate rate, reducing the corporate rate, there's really nothing else. There's nothing in the tax law that relates to associations, and filing under an 1120H, that's still the same, and that tax rate's still the same. So it's just on the corporate rate structure that was reduced. But other than that, nothing too much there. Another question. So, and this, we get this question all the time. Should the cost of the study be charged to the replacement fund? So since you kind of talked about...
Yeah, actually, technically it should not, because the replacement fund is for the replacement, major repairs and replacement of the common elements. The study itself is actually more of an administrative cost. That's why I said that if you have your deferred maintenance schedule, you can put in there the reserve study and fund for it. If it's going to cost you, I don't know what, $2,000-3,000, you fund the money in there. So you have them in the third year, you have the $3,000 to have the study updated.
And just a quick note too on that. Sometimes you can have engineering fund expenses in the replacement fund if they're directly correlated as oversight to a project. So I wouldn't say sometimes people might see the professional fees and raise the question if it's direct oversight or directly correlated to a capital improvement, then those professional fees can flow through the replacement fund.
Absolutely, and normally the engineer includes that on the big projects. Yep. That a contingency and an engineering fee and an oversight is included as part of the cost of that project when they include it in the line item. So that's a good point. Do we have time for another question? Let's see. This question, and I'm not sure whether or not this has been answered or not. I think we talked about operating cash and working capital. Is there a difference between operating cash and working capital cash, or it's
no, the thing is that I have a few associations where working capital is a whole different fund. Then if that's the case, yes, then you should have two different bank accounts. But sometimes the working capital is within the umbrella of the operating. So you have two different bank accounts, but on your balance sheet, the working capital cash falls under the operating fund fund balance. So cash balance. So.
Okay. We talked about the IRS concern about the replacement fund, and I think this might have been covered earlier, but just in case, does this mean that the funds in deferred are considered as operating surplus?
Yes.
Yeah.
Yes.
Yeah.
Yes.
So in the eyes of the IRS, operating deferred are basically one and the same. The deferred is really to help in budgeting, as Mohammed talked about, but it really is operating. And lastly, so there's times when there's no interfund is recorded because replacements or deferred maintenance is paid through the operating fund in the normal course. So an interfund isn't actually recorded. So I'm guessing that means that maybe you're not seeing it on your, your internal financials.
See it on the internal financials, but there is an interfund that does exist. So the easiest way to do it, of course, is to look at the cash balance of your reserve bank account and look at the fund balance at the bottom on your balance sheet and see if those two agree to each other. And if they don't agree to each other, then you have an interfund balance.
Yeah. Okay. Exactly. Thank you. That's a great way on because I know Mike has mentioned on some of the internal financial statements, but certainly comparing that. And does doing a yearly budget help keep the interfund from becoming a problem?
I think as you could see on the common causes tab, a lot of those tie into the deficit. So you just really want to make sure it can help. It doesn't necessarily 100% prevent it, but you want to avoid situations where you're going to put strain on a fund and force that fund to, borrow in funds and lean against another fund for support. So having a budget definitely does go a long way in helping to avoid it, but it's not a guaranteed solution. It's definitely a key indicator that can sometimes cause them, but
right.
Yeah, I think the most important thing,
Go ahead.
is to make sure that you're budgeting accurately.
Right.
on an annual basis, your repairs and maintenance runs at about 50,000, but then you budget for 30. That's not being realistic.
Right. That's a guiding principle. Another guiding principle is try to budget as accurately as possible, then your fees will be set as accurately as possible, and you'll have the money to do what you need to do.
Right.
All in a perfect world. So thank you very much, everybody, for participating in our webinar. Our phone numbers are on the screen, our emails are on the screen, and our website is also located on your screen. So if you have any questions, please feel free to reach out to us. You will be getting a survey afterwards. We welcome your feedback. We're always interested in other topics that you may want to have presented. And if you have any other questions that weren't addressed, feel free to reach out to your Wilkin and Gutton Plan consultant, and we'll see if we can help you out. Thank you very much, and have a nice day, everybody.
Bye-bye.